all investors, thank you for joining me. Today I want to talk about Paysafe. This is a stock that so many of you have written to me asking me for a follow-up after last month's results. So I'm going to discuss through what has happened in the last month, and we're going to talk about what are the prospects here for shareholders. So the headline is here that the stock is being priced at 3 times next year's sales. So that isn't criminally expensive. What's more, it has actually quite a lot of profitability at the EBITDA level. So let's just kind of dig in right here, right? So the stock announced last month that they're going to be growing this year at approximately 10%. So for a company that is with exposure to iGaming and payment solutions, you know, this is such a very hot sector right now that investors are just clamoring money and just really willing to invest anything in this space because it's really hot space right now. And the thing is that when it comes to it, there's a good reason for this, right? So more and more states are willing to adopt betting solutions, and as of next year, going into 2022, nearly 45% of the US population will be covered and be able to bet on their mobile phones. So you know, this is something that's obviously attracted to a lot of companies, and in fintech and in iGaming, there are many other companies that are just so much determined to get customers on board that they're really substantially unprofitable. With that in mind, Paysafe is a profitable company, so you know, investors are not totally irrational for having been attracted to this business. Another thing that I want to highlight is that I didn't put it in the article, but if you look at other companies that for example, Skills, Hims, if you look at Bark, many of these companies that went through kind of and did a SPAC deal or IPO'd last year, are just, you know, they're just kind of really, the market has really had nothing to do with them, and irrespective of the underlying potential, the market has just been throwing these SPACs all into the dust and saying, okay, I don't want anything to do with these high growth names. But the problem in the case of Paysafe is that it's not really a high growth investment. It's growing at approximately 10%. So it's not really something that's really gonna drive and get the momentum crowd involved. On the other side of the equation, you know, it is a company that if we say that this year, take their guidance that they're going to be at approximately just below 500 million of EBITDA, and we say that, okay, yeah, they're guiding for approximately 15% more or less of EBITDA over the near term. So let's just say, for the case of the discussion, they made 570 million of EBITDA next year. That puts the stock trading for less than 10 times next year's EBITDA. So, okay, yeah, that's, you know, that's something that's quite interesting, right? So you're not paying a large multiple to EBITDA for a company that has exposure to a strong market. Now, here's the problem. The company is meaningfully leveraged, okay? So you don't want to be getting involved too much with a company that has much above 3.5 times net debt to EBITDA. You kind of want to get it closer to 3.3 at least, you know? You don't want to be paying such a high leverage. Secondly, as I discussed amply, it's not really growing that much. So if it's not growing that much, it's going to be difficult to service that debt. The other thing that I wanted to highlight is that their free cash flow conversion isn't that strong. So yes, they do have a lot of EBITDA, but you can see here in the graph for the quarter just ended in June, their free cash flow conversion from EBITDA was less than 50%. So, okay, there's a problem right here. So yes, it does make a lot of EBITDA, but it's not really converting that free cash flow very significantly. The other thing that I wanted to note is that if you think about it, you can see in the red arrows here that the biggest portion of the EBITDA being added back is interest expense and depreciation and amortization. So this is a company that's highly acquisitive and has a lot of debt. So it has to service those debt payments, that adds back to the EBITDA, and then it acquires the company, and then it has to amortize and depreciate a lot of those intangibles. So yeah, I mean, on the surface, yes, it does have a lot of EBITDA, but then once you start digging in, the free cash flow is not really there. So many people said, oh, Michael, you just don't see that this company is going to be something similar to PayPal. And I say, okay, yeah, I get the argument. PayPal is priced at approximately 10 times next year's sales. This company is priced at 3 times next year's sales. this company seems to be cheap, right? Well, not really. First, PayPal is a global company. Secondly, PayPal is a household name. Thirdly, PayPal is making close to 26 billion in revenues this year. Okay, this is not on the same league as Paysafe. Next, PayPal has a long history of making approximately 19 to 20% free cash flow margins. This is not the same level of company as Paysafe. So yeah, so these are my thoughts right here. So yes, I know that many of the SPAC names have unwound, and many are trading really cheaply this year. And if we look out the next 2 years, most likely many of them will be priced significantly higher. But it's important to be very selective, and I don't think that Paysafe is one of these investments that investors should really kind of be particularly willing to deploy their capital towards. If you want to find out what kind of names I'm deploying my capital towards, don't forget to check out my marketplace. It's called Deep Value Returns. Come in, get involved, find out the stocks that I'm interested in. I'm not going to replace you as the investor. I'm just going to offer you 1 or 2 ideas a month that you can say, okay, yes, this is something that really resonates with me, and someone's done the due diligence on it, and I haven't really at this moment in time the time or inclination to find new investments. Or you can just be new to investing and you just want someone to handhold a little bit. Don't forget to check out my marketplace. You're welcome to do a totally free trial to see if it suits you, and you can unsubscribe anytime before the 14 days, and you're not going to get charged anything at all. So you have absolutely no reason not to get